Good morning. Let's look at chapter 14, cash flow. The two basic statements using accounting are income statement and your balance sheet. Income statement being for a period of time, right? Revenues and expenses, those get zeroed out to income summary, closed out to retained earnings. Then you got your balance sheet, which is a point in time, and those are permanent accounts. It never gets zeroed out. Very important to remember that in everything you do, no matter how long you've worked in accounting, whatever level. So keep that in mind as we look at this cash flow statement, because it is for a period of time. And in essence, what you're trying to do with a statement of cash flows is explain to management what's happened to your cash balance year over year. Because everybody wants to know what happened to cash. Very common, no matter what size company you're in. So statement of cash flow, in essence, is you're trying to take your net income, which is accrual basis, right? You recognize your revenues when it's earned and accrue those expenses as they're incurred, not cash basis, accrual basis of accounting. And so what you're doing with statement of cash flow is taking your income from an accrual basis and really converting it back to cash basis. Rarely does a book tell you that, but that is in essence what you're doing. So keep that in mind as we're going through here. We're trying to convert cash from, or income from an accrual basis back to a cash basis. All right, so let's look at these exercises here. I'll tell you what, before I do, let me just talk a little bit about here. And I don't have my scratch pad active, but I can show you what I've got here, which is probably just as good. What you have there is the three sections of a statement of cash flow. You got an operating section, you got the investing section, operating, investing, and financing. Three sections. That's always part of the issue is where do I put these changes, whether it's the income statement or the balance sheet, where does that go? And it's one of those three sections. Now, what are you trying to do when you're using that income statement for a year and you're using the balance sheet for 2 periods? The only thing you need off your income statement is net income or loss, depreciation or amortization or both, and then if you've got any gains or losses from where you've sold assets. But primarily it's usually 95% of the time it's net income plus depreciation. That's where you start, and that's operating. And say, what's operating? Operating is just your core business. It's really trying to look at what kind of cash flow are you driving just in your core business. All right, so what else goes in the operating section? And the PowerPoint does a great job, so I hope you look at the PowerPoint. It does a great job of telling you what I'm showing you right here. Once you're done with the income statement, right there, those 2 line items, net income, depreciation, losses and gains. Once you're done with that, you put the income statement away. You're finished with that. So from this point on, then you're looking at 2 areas: your balance sheet from one period and your balance sheet from the prior period and the current balance sheet. And that's what you're trying to explain, what happened to cash. So then you're going to put the change in all your current assets, the change in all your current liabilities in the operating section, because current is operating, right? 12 months or less. And then the investing section has your long-term assets. And then finally, because investing is where you're taking cash and investing in the property, plant, and equipment, or intangibles like patents and copyrights. And then finally is the financing section down there at the bottom. And so that's everything else, the change in your long-term liabilities, right? Current liabilities are up here, so the rest of your liabilities go down here, long-term. Bonds payable, we just had the exam on bonds payable, notes payable, mortgage payable, all those long-term liabilities. And then finally, the change in your equity. Things like common stock and preferred stock. Now, it wouldn't be retained earnings because your net income is up here, remember? So you're not going to put net income down here again, but in retained earnings, you do have things like dividends that have to be accounted for. And so dividends would go here. So we've accounted for all sections of the balance sheet, haven't we? Current assets, current liability, there's my long-term assets, so assets are done. There's current liabilities and long-term liabilities and equity. And so that's really a good template to use when you're trying to think, how am I, and it doesn't matter how large of a company, if it's $1 billion company, it's still the same principle. And the PowerPoint and the book talk about 2 methods. There's an indirect method of cash flow statement preparation. There's a direct method. Every company I've worked for and done work for uses the indirect method. And so this is the indirect method. And that's what we're focusing on. The direct method, you don't have to worry about that in this class, or for that matter, in 30/20 if you decide to major in accounting. All right, so once you know where does it go, the question is these changes in, because that's what that is, changing current assets. If my accounts receivable goes up or goes down, is that a plus or a minus, right? So now you know where it goes. The next question is it a plus or a minus? And I've got that on my next page here. I just scribbled out. Now the basic balance sheet, assets equals liabilities plus equity. You know from middle school algebra, which I didn't take till I was in high school back in the day. 9th grade is when you had algebra, but you probably had in the 6th grade. Remember the algebraic equation? Whatever's on this side, what happens when you go across the equal sign? The sign changes, doesn't it? Well, it's the same way with accounting. You have a normal debit balance for an asset. What's the normal balance over here? Well, it has to be a normal credit balance. Same principle, pluses and minuses. And so whatever happens over here, the opposite is going to happen there. So what I've got up here is just a very simple rule. The book and the PowerPoints make it a little bit more difficult than it really should be. But if you got an increase in an asset, meaning what if my accounts receivable went from $1,000 up to $2,000? That's a negative. So that change of $1,000 will be put on this statement as a negative 1,000. You think, well, that doesn't make sense. My accounts receivable went up. If an asset goes up, is that not a good guy? Well, no. From the standpoint of a cash basis, from the standpoint of an accrual basis of accounting, because what's in your net income? Go back and think about that. Your net income is for a period of time. And if my accounts receivable went up, that means I've got revenue that's been booked in my net income that I haven't received cash for. So accounts receivable goes up, that's got to be a negative. And the good thing about it is any asset that goes up is a negative, right? Think about inventory. The inventory goes up, that's, I've spent cash on that, but I didn't get, if inventory went up, I didn't sell the inventory, right? Property, plant, and equipment. How does property, plant, and equipment go up? Because you took cash and bought something, didn't you? So that's another situation where, again, any asset, all assets that go up, that is a negative to cash. Negative to cash, that's a minus, not a dash. Minus to cash. All right, and so if you jump across the equal sign to a liability, what do I say there? An increase in a liability is what? A plus to cash. We're going to add that on our financial statement or on our cash flow statement. And if you're going to do that for liabilities, then it has to be the same for equity. So think about what's going on there. Why would, and you just had this on your exam for chapter 13, right? Long-term, or is that chapter 12? Well, long-term liabilities like bonds payable or notes payable, remember the journal entry? You debit cash and credit bonds payable or notes payable, right? Cash went up, didn't it? Because my liability went up. So an increase in a liability like selling bonds or a note payable or a mortgage payable, that's a plus to cash, right? And it's the opposite once you go across the equal sign. Think about equity. You sell stock, right? You sell stock, preferred stock or common stock. You debit cash and credit common stock, credit preferred stock. Again, it's the same principle. Cash goes up. So anytime a liability or equity goes up, normal credit balances, and they go up with a credit entry, that is a plus to cash. All right, so let's look at these exercises. That's the chapter, and that's a 8-minute version of the chapter. I won't make this too straightforward, but still, you need to read the book and look at the PowerPoints to really gain a full understanding of what I just told you. That should cement what you've been looking at there. So let me share the homework here. See if I can get through this in an hour. Share screen. All right, so there's practice set 1 for chapter 14. First one here is pretty straightforward. It's a lot easier to do this in my office than at home. Not very, my laptop's not very user-friendly. It's about 7 years, it's a new one, but it's 7 years old. All right, so what's going on here? You can read that, the answer. I don't need to talk about it anymore. Why do we do the cash flow statement? Everybody wants to know what happened to cash at any level. What changed in your cash balance? All right, number 2, very straightforward there. What section, you know, I was talking about that just now. Where does it go? It's either operating, financing, or investing. Remember that page? You can go back there and look. I'm not going to unshare the screen. Is it OI or F? Operating, merchandise inventory, that's a current asset. Payment of dividends, that's what? That's related to stock. Retained earnings goes down. Financing. Always look to see the account title in here. Cash received from the collection of long-term notes receivable, right? I emphasize long-term notes receivable because that says what? That's a long-term asset. Where does long-term asset go? Investing. Cash payment for income tax sounds like a payable, doesn't it? So that's short-term. Operating. Payment of purchase of equipment exchange for a notes payable. Well, that's a non-cash item. Now, that's something I haven't touched on. Purchase of equipment exchange for notes payable. So there's no cash involved. So that's going to be something you just highlight at the bottom of the page below the line items of what you're actually calculating. It's almost like a footnote disclosure. Cash received from the sale of land. Land is what? Long-term assets. So that's got to be investing. Cash received from borrowing money. That's got to be financing, right? That's a long-term liability. Think about where it is. Cash received for interest income, operating. Cash received for issuance of common stock, financing. Salaries, that's going to be salaries payable for short-term, operating. All right, number 3. All right, here's our first exercise. I can get all that on one page. Looks like I can. What we got here? Yes, I guess I'll have to make it a little smaller so we can see it. There's the basic, this is the operating section only. There's the basic format. You start with your net income. We're trying to reconcile net income from accrual basis back to cash basis. There's my 65,000. There it is. I'm also looking for what? Depreciation. They've got the balance sheet income statement stuff here in just one simple format. So there's my 65. You always add back depreciation. Why do you add back depreciation expense? Well, think about it. Depreciation is a non-cash expense, right? The cash went out when you purchased the equipment or whatever it is. It's a long-term asset. But when you start depreciating that, what's the journal entry? Debit depreciation expense, credit accumulated depreciation. There's no cash involved. You're just allocating that. You're allocating that cost over its useful life. That's what an asset is, an unexpired cost. And so that cost is allocated to expense, right, over its useful life. That's why assets and expenses both have a normal debit balance, right? A normal debit balance. So once it comes off the asset, it goes to expense. There's no cash involved here. So that's why you always add back depreciation. You add back amortization. Always add it back. Not a subtraction. It's always an add back. Net income plus depreciation. All right, so that's the first 2 lines there. 65,000 plus 4,000. All right, what else is going on there? Then we want to look for current assets and current liabilities. All right, cash received from sale of land, that's not a part of this. That's an investing activity. Payment of dividends, that's a financing part. Common stock, right, that's financing. Purchase of equipment, that's not a part of it. What about decrease in current, because that's cash purchase of equipment is investing. Decrease in current liabilities, 5,000. So liabilities went down. So think about what happens with liabilities going down, current liabilities. Because it means take accounts payable, for example. What if my accounts payable was $100,000 last year? Now my accounts payable was $200,000. It went up But how does it get into accounts payable to begin with? What's the other side of that? That's a credit entry. What's the other side of that? It's a debit to expense. So this is a good example. If your accounts payable went up, it's probably because the company's not paying their bills. And so that's cash that they are holding in essence. So I need to add back that increase in the liability. It goes right along with what I just talked about, common stock and preferred stock and bonds payable. Cash goes up because those liabilities went up. It's the same principle with accounts payable. Accounts payable goes up, you've got more cash. So in that case, it says decrease in current liabilities. That's got to be a negative. All right, and then the last one, increase in current assets other than cash. You never put cash on here because that's what you're reconciling. You're trying to come up with, in total, for all of this, what changed to cash. So increase in current assets other than cash. So all your inventory, prepaid expenses, all the stuff that might be in there that's a current asset, they went up. So if it went up, that's got to be a negative. And so the total, that's 27. So you can see the answer there is 38,000. All right, what about number 4? Here we got an income statement, and they're wanting you to compute the acquisition of plant assets. Sold no assets during the year, seeing the company paid cash for the plant assets. So here we got an income statement. All right, depreciation 17,000. I don't even know if we need to look at that. In the balance sheet. So there's my balance sheet. Plant assets went from 86,350. It went up 22,000, didn't it? Yeah. So there's your answer. Accumulated depreciation, that should be from your income statement. Depreciation 17,000. So 22,350 plus 17 is 39,350. Of course, you don't need that. But there's the 22,000. It went up from 86 to 108. And how does it go up? They paid cash to buy these assets. All right. What's the other question here? Compute the payment of a long-term note payable during the year the business issued a $5,100 note payable. $5,100 note payable. All right. So we start out with 16,000 and end up with 11. What about that 5,100? Let me see if they've got a T account on here. Yeah, there it is. And there's the plant asset as well. They're showing the 86,350. And there's the ending balance, right? There's one balance sheet, there's the other. And so you had a debit entry to make that 108. So there's where they came up with the acquisitions. And they told you they didn't sell anything. All right, what about my notes payable? So there's my $16,000 to begin with. All right, and there's my ending balance. But it also says there that we issued a $5,100 note payable. So if I issue the note payable, means I have a debit to cash and a credit to note payable. There's my credit from the general journal that's been posted to my general ledger. So 16,000 plus 5,100 is 21,100. So I'll get from 21,100 to 11,000. There's got to be a debit. Right? 16 plus 5,100 is 21,100. And if my ending balance is 11, that means I made a payment of 10,100. Right? So use T accounts. I mean, I was controller for many years. Even after 30 years doing stuff like this, I still use T accounts. Very important. Very easy to see visually what's going on with your accounts. All right, number 5. Let's see here. Again, this is one of those where does it go? You can look at that yourself, and I won't need to spend time on it. All right, number 6. All right, good exercise here. Again, here they want you to show, is it operating, investing, financing, or a non-cash item? Means it goes at the bottom, NIF. And they also want you to put, is this a plus to cash or a minus to cash? Very good. Loss on sale of land. All right. Loss on sale of land. The loss, I mean, they're not worried about it since you just got to put it in one place because in essence, it probably would go in the investing section as well, but they're talking about just the loss on the sale of the land. Remember, a loss is added back. That's back there on this chart I had up there at the top. Add back losses, subtract gains. So that's operating into the plus. If it had been a gain, it had been a minus. Acquisition equivalent by issuance of note payable. So that's a wash. So that goes to the bottom of the statement of cash flows. It's not part of O, I, or F. Payment of long-term debt. So there's my liability. I'm paying down the debt. That takes cash, doesn't it? So that's got to be a negative to financing. Acquisition of building by issuance of common stock. Again, there's no cash involved there. NIF. Increase in salaries payable. Liability went up. That's a good thing from a cash standpoint. So that's going to be an O plus. Decrease in merchandise inventory. Asset goes down. That's a plus to cash, right? It's like accounts receivable. If accounts receivable goes down from one period to the next, that means you collected cash on sales from a prior period, not in the current period. And that's not in your net income for the current period. All right. I don't know if I need to go through all those, but you can see the answers going down through there. All right. So that's the first practice set. Yeah, I didn't mean to do that. Practice set 2. All right, hopefully you can see that. It says it's sharing. All right, so some of these get a little bit more involved. I don't think this one does. This one's similar. They're just doing the operating section. So let's look at the records of McKnight. And get all that on one page. All right, so you always start with net income and add back depreciation. Very simple. Net income 41,000. There it is. There any depreciation right there is 12,000. So 41 plus 12. Again, this data table is a combination of income statement and balance sheet stuff. They're making it really simple. In a minute, they're going to break it out into two separate statements. All right, it says there's a loss on the sale of the land. We add back losses. We would have subtracted if it had been a gain. So add back to 5,500. So in essence, you're done with the income statement part of what's up here. All right, then we're wanting to change in current assets, change in current liabilities. So we're going to look through here for that. Decrease in current liabilities, 22,000. So if my liabilities went down, that means I used cash. So that's got to be a negative. So there's a negative 22,000, and an increase in current assets other than cash. Again, you go across that equal sign, the opposite is true. Once you learn one of those, and asset equals liabilities plus equity, once you learn one, just on the test, just go ahead and put that out there, and then you'll know what goes up and what goes down. Of course, you're doing this online, so you can have that in front of you before you start. All right. All right, so increase in current assets, 8,000, so that's a negative. There you have it. Pretty straightforward. Well, that number 2. All right, so now we got a big boy here. We got the whole thing. All right, so what's going on? We've got an income statement. Messages on my computer here. All right, so we got our income statement, a full income statement like you would have in business. And you see that the net income there. What else are we looking for? We're looking for depreciation. There's 25,000. So there's 53. Add back to 25, and I don't see any gains or losses. All right, so we're done with that one table, aren't we? So there's my 53 plus the 25. So now what's left? We're going to go through here and do a comparison of each account between assets, liabilities, and equity. Now, Pearson does a little bit different here as well. They tell you some of the specifics associated with how you plug this in. Normally, I wouldn't have that if this was an intermediate class, but I think sometimes even in principles, it might be a little more confusing. But let's just go down through here. We can see the solution. We want to look at each of these accounts and we'll go back up here to the top here in a minute. We're going to go through here based on the solution. I think it's the easiest way to keep up with this. I'll get my face out of the way. So cash, this is what we're trying to explain. Why did my cash go up 25,000? That's the whole point of this exercise. Why did cash go up 25,000? Because when we're done down here at the bottom, right there, we want to explain this $25,000, right, increase. That's what we're trying to explain. Because there's my beginning balance, 7,000, and there's my ending balance. So that's what we're trying to explain. All right, so let's go back up here and look at the change in our current assets and current liabilities. So cash, you're not putting that up here in the operating section. That's what the overall exercise is doing, explaining this $25,000 difference. So here I've got accounts receivable went down, didn't it? It went down, looks like $14,000. So accounts receivable, anytime an asset goes down, that's a plus. So there's my plus 14,000. All right, inventory went up 7,000. So inventory asset goes up, that's a negative, right? And then we skip land assets. We skip that because that's going to be in the investing section. And accounts payable went up 14,000. So if accounts payable went up 14, that means that's a plus. We're not paying our bills, are we? We're holding cash. And accrued liabilities, which is same thing there. I mean, you're comparing it just like accounts payable. It went down 9,000, so that's got to be a negative. All right, so we're done with, because notes payable is long-term, common stock retained earnings. All right, so that tells us that we have 53,000 plus 37,000 from this change in current assets and current liabilities and depreciation expense, your non-cash expense. So that's 90,000. All right, so we're done with the operating section. What about the investing section? All right, there's some language up here at the top that tries to make it a little bit simpler. It says that they acquired planned assets of 117,000. Of this amount, 102,000 is paid in cash and 15,000 by signing a note. So they're saying 15,000 of that is a non-cash item, which is going to be down here at the bottom. Right there it is. Acquisition of planned assets by issuing no payable. That's below all the calculations. It's a footnote. All right, so what's important up here is the 102,000 is paid in cash, right? So they debited assets, planned assets, and credited cash. So that's why you're showing this as a negative to cash. Asset went up again. Asset went up, didn't it? Long-term asset. All right, and then also said cash received from sale of land total is 26,000. There was no gain or loss. So again, 26,000. Then that's going to be what? That's an asset going down. Your long-term asset went down. Cash went up, but that's what we're trying to explain. You're just looking at the side that's impacting cash. So land went down because I sold it and brought cash in. All right, and so that gives you $76,000 for the investing section. All right, and so that leaves us the financing section, which is last. All right, it says that we sold stock for $33,000. Pretty straightforward. You debit cash for $33,000, or you debited cash for $33,000 and credit the common stock. So again, anytime a liability or equity account goes up, that is what? That is a plus to cash. And say we payment of notes payable for $14,000. So how do you pay notes payable? You take it out of cash. So you debited notes payable and credited cash. So that's where your liability went down. Anytime a liability goes down year over year, that's a negative. And then cash payment of dividends, that's pretty straightforward. If you pay dividends, it's got to be negative for $8,000, which is coming out of where? Retained earnings. All right, so there's 11,000. There's a solution. They have all that down through here. If you want to work through each of these, you can see there's the 25,000 accumulated depreciation change, right? There's my planned assets. So you are reconciling planned assets year over year on your balance sheet here onto your statement of cash flows. And even though they gave you information up there, you could do this entire statement without any of those explanations up there just by following this. Because in the end, this is what you have to reconcile. You're reconciling accounts receivable all the way through retained earnings. Look at retained earnings, 260,000. I'll just throw that out there, 260,000. Says our net income was 53,000, right? So what's 260 plus 53? 260 plus 53. 313,000. And it said I paid out dividends of how much? 8,000. So that says my retained earnings should be 305,000. There it is. So you can reconcile everything on here, and that's a great exercise to do just for your own learning. Each of these. 260, you always add net income or subtract the loss, subtract any dividends, and that gives you your ending balance of retained earnings. All right, so that's a good exercise. It takes you through using the actual balance sheet and income statement. Then number 3, what we got going on here? All right, the same information's there. It looks like that compute the amount of Jetson exercises acquisition of plant assets. Depose the plant assets at book value means there's no gain or loss. The cost and accumulated depreciation of the disposed asset was 43.5. So that's what happens when you sell something. You take it out of your accumulated depreciation, right? And you take it out of your original cost. Both accounts are going to be zeroed out. So they want to know what were the acquisitions. So it's kind of like a little puzzle here. You don't really need that, but just looking at it, there's your net income and there's your depreciation expense, 135 and 48. But I think they use a T account here, so let me just pull that up. Yep. So what you got here, your beginning balance of plant assets, 227.9, right, and 270,400. Because it told you there was no gain or loss, and the same amount came out of accumulated depreciation. So you really don't need to look at accumulated depreciation, although you can do that as well just to see how all this flows together. But you can just look at plant assets for this. So 227.9 to 270,400. All right, so there's my 227.9. There's my ending balance. And it says here that we disposed of 43,500. So there's my disposal for 43.5. That means that comes out of my original cost. So 227.9 minus 43.5 gives you a number that you then compare with the ending balance, and the difference is your acquisitions, which is the question here. So 227.9 minus 43.5. We'll write this down as 184,400. That's your balance from what's known, right? That's what's known, 184.4. And it says my ending balance is 270,400. So 270,400, if I subtract that, that says I've got $86,000. That has to be a debit to make this balance, right? This plus this, this minus that plus this is equal to this. If you're following my cursor there. That minus that plus this is equal to that. Like this and that. But you can do the same thing with accumulated depreciation. If you start out with 38,900, it says we had disposal. See, there's the 43.5 and the 43.5. You're taking both those off the books because it's gone. So 38.9 minus your disposals plus there's your depreciation expense that you had for the year is equal to that. If you want to just look at accumulated depreciation, just out of curiosity, how a T account works. And I can't stress enough how important T accounts are for you to understand what's going on here. All right, so what's number 2? Compute the new borrowing or payment of long-term notes payable. I only have one long-term notes payable transaction during the year. So 64,000 minus 67,000 is 3,000. I guess that's what was on the balance sheet here. Yep. So you went from 2017, you went from 67,000 down to 64. So you paid $3,000 down out of that notes payable. Payment of long-term notes payable is 3,000. Compute the issuance of common stock. I go down here and look at common stock. Common stock went from 35 to 47. So you've got $12,000 of stock that you issued. What about cash dividends? Again, beginning retained earnings plus your net income minus ending retained earnings is your dividends. They don't show you the T account on that, right? But if you were to do a T account, I can pull it up here. How am I doing on time? 36 minutes, 35 minutes. Retained earnings. It's 238.5. Net income's 135. Ending retained earnings is 293. We'll have to do it. Stop screen share. Right? So if you add those two together, beginning and net income, what does that give you? That is 373.5. $80,500. Hopefully that was the answer. So there's your beginning retained earnings. You know what your net income is. So that gives you a trial balance number of that. And so if we know the ending balance is this, then our dividends must, because that's the only thing that comes out of retained, only other thing that impacts retained earnings. You get prior period adjustment, but you don't have to worry about that in this class. So dividends should be 80,500 to make this thing balance. All right, let's go there and see if that's right. Yep, 80,500. But T account sometimes is easier to understand than looking at a calculation like that, because I really like the way they do this at the top. Love that. That's the way it should be. Although I would argue they need to use more space like I did there and show your totals, because you can't really tell, well, what came first. That should be on a separate line below here. All right, so that was the end of practice set 2. Let's stop the screen share again. Let me pull up the self-assessment. And I'm not sure it's sharing it, so let me go back and do it like this, just to make sure. All right. So here we've got 2 exercises. I've got time, it looks like. Let me click on the answer. I'll change all the numbers. All right. This is similar to what we did in that other practice set. Maybe a little more complicated. I don't remember exactly. It's not any non-cash items, is there? So we're trying to figure out here, if I started with $15,000 in cash on one balance sheet to prior year's balance sheet, remember, point in time is a balance sheet, and now we're at 18,000. I want to explain, why did my cash go up $3,000? Because what happened? I got net income of $122,000. So think about it. If you're making income statement balance sheet for really non-financial people who may be running your company, they say, man, I don't understand that. We had $122,000 in income and my cash only went up $3,000. Because everybody thinks $122,000, I should have $122,000 more in cash. Well, that's the whole purpose of this statement of cash flows, because this is accrual basis of accounting. Has nothing to do with cash. So we're, in essence, again, I've said this before, we're trying to convert back from an accrual basis of accounting to cash basis. All right, so what's going on here? Let's pull up the income statement. What are we looking for on the income statement? We're looking for net income, and we're looking for depreciation. 122 plus 46. Thinking out loud. There's no gains or losses, so I'm done. So 122 plus 46, there it is. I'm done with that statement. Now everything is all about my balance sheet. What's this one? Oh, they got other information here. All right, well, we'll kind of keep this up here. I don't know if I keep them both live at the same time or not. Maybe I can. There's my face again in the way. All right, so let's just go down through here on our balance sheet, because if you didn't have all this stuff here, if you didn't have that, you could still do this problem. I want to emphasize. I think Pearson thinks, since this is principles, that this might help. I don't know. But anyway, let's go down through the balance sheet, because once you're done with the income statement, all we're doing is comparing your accounts receivable, inventory, long-term assets, long-term liabilities, current liabilities, equity. So there my accounts receivable went up 5,000. So we know that's a negative, right? You know that by now. Accounts receivable went up 5,000. That's $5,000 of revenue that's in your income statement that you didn't receive cash for. All right, a decrease in merchandise inventory. So it went down 4,000. So that's a plus. All right, what else is on there? Accounts payables, because we're going to skip long-term assets because that's in my investing section. And so my current liabilities, accounts payable went up 7,000. So that's good because we're not paying our bills, are we? And salaries payable went down 5,000. So that's a negative. So that tells us, well, you can read that here in a second. We'll keep going. All right, what else is going on here? Cash payment for acquisition of plant assets, 90,000. Well, they tell you that. Acquisition value of plant assets, 90,000. Can we see that over here? But it also says, which isn't there, it says that we had, we got rid of some assets that were 43,400. So if you got plant assets here, 212,600, and I bet they've got a T account for that somewhere. Then again, maybe not. We just did all of that, so we're done. All right, so they're telling you, so you don't have to actually do the T account, but acquisition of plant assets, 90,000. But how else can you calculate this? I don't know if I should have to go through all this or not. Video will get too long. I mean, for purpose of an exam, I'm not going to have it different than what you see on stuff like this. But if you start out with 212,600, if you're going to be an accountant, you might want to understand this because you'll get this full force in 30/20. But I know most of you are not accounting majors. So we started out with 212,600. 259,200 is my ending, but it says I disposed of 43,400. Let me go ahead and calculate it before I share the screen. Something just beeped at me. All right, up to retained earnings, bottom part there, plant assets. So there's my beginning, right? Debit balance of my property, plant, equipment, or plant assets. It says that was given. I disposed of 43,400. So there's my new balance. And so if that's my due balance and that's what's given as my ending balance for my balance sheet, then I must have what? I must have acquired $90,000 of plant assets, which is what they're giving to you up there in what they're giving you there in these instructions, right? So they're trying to make it simpler by giving you the 90,000. But again, you can calculate it for yourself as well. All right, same thing with dividends. I mean, you can take your retained earnings down here, right? I don't need to go through that again. You start with 213,500 credit balance. That's your ending credit balance. You're adding that net income to the 213.5. And if you subtract 41,000 from it, it's going to give you 294.5. All right, but you don't have to do that. They're trying to make it simpler. Same way with these long-term notes payable and so forth. So let me get rid of that over there, pull that over so we can kind of go down the page here. Cash payment for investments. Maybe I need to look at that one though. 29,000. So 71,000 is my beginning balance of investments. Ended up at 100,000. So there's my 29. Nothing going on there, right? So that's got to be cash. Asset went up again. Just like that asset went up. That's why they're negative. All right, and then the bottom part is just, there's my 41,000. There's my 12,000. Payment tells you it's got to be a negative to cash. And then cash receipt from issuance of common stock. It almost gives it away whether it's a plus or minus. All right, so that's pretty much that problem. All right, let me get through this because the video's getting long. I think I've been going at it for 45 minutes. One more. Identify any non-cash transactions, what it says. Non-cash transactions that occurred during the year. So we want to look at this. And this is the bottom part. This would go below what we just looked at in that prior problem. There weren't any, but these are non-cash items that are really just there for descriptive purposes. Has no impact on your calculation of reconciling cash. So it said we issued shares. Well, that would be up there in the body of your statement, but we're not doing that here. Issued these shares, so that's irrelevant. Purchased a new truck with a fair market value of 28,000, financed it 100% with long-term notes. So there you go. There's 28,000. Oops. B is up there. Issue 400 shares for a building with a fair market stock for a building. So that's stock in a building. There's no cash involved. So that 93,000 would be there. I went too fast. So B is here. C is there. Retired short-term notes of 21,000 by issuing stock. All right, so that one, that has nothing to do with cash. All right, think about the journal entries, what you're doing. Think about the journal entries that you learned about in 2010 and in 2020 on this last section that we were in Module 1. And then paid a long-term note, that tells you that must be, you're paying a note, you're using cash. So only 3 of these are what's called non-cash items, non-cash transactions. All right. That was 50 minutes of chapter 14. So I hope you learned something from this video, and we'll do another one soon for chapter 15. I hope you have a good day. If you have any questions, as always, just email me and I'll be glad to help you.